The first thing that comes to mind when people think of investing is stocks, the stock market. Let's just explain what stocks are. A stock is simply a piece of a company. These large companies or a smaller company, like my company, I could have 2 shares of stock, and you could have 1 share, and I could have 1 share. But these great big companies that are worth, $100 billion or $500 billion or even $100 million, most people don't have money where they can, the kind of money where they can buy the whole company, so they can buy a piece of the company. And so that's what all a share of stock is. And so when you own a share of stock, you own the company. You don't have total control over the company. You only have control over a proportion that you have, but you get voting rights and all that sort of stuff. And your stock share, that piece of ownership, can go up or down in value based on a number of factors.
Mm-hmm. And so here are a few factors. Well, it's a pretty good list of factors that can cause the market to go up or down. And again, this is a lot of things.
Causes an individual stock to go up or down.
Right.
The whole market, right.
Right. And so there's a lot of things that come into play with the value of a stock, but in its simplest, it comes down to there's kind of 2 different ways to value a stock. So there's the true value, and let me just explain this chart really quick. So over here on the left is price, over here on the right is time. The blue line is intrinsic value, which means the true value of how much your piece of the company, the stock that you own, is worth. And the intrinsic value, the true value, is in blue. The value of a company goes up based on how profitable they are, as far as the earnings that they're reporting right now, and how profitable that they're expected to be in the future. And so you can see this line over time. If a company is managed well and they're successful and they're doing well, they might have some ups and downs, but their value, their true value, is going to go up over time. Well, this red line is the market price of your piece of that company. And that's a lot more volatile because that's based on things like supply and demand, things like investor sentiment, things that are going on in the news, whether people are feeling fearful or confident in this particular company or the particular industry that this company is a part of, things like that. And that's going to go up and down a lot more than the true underlying value of the company is going to go up and down. And so there's going to be times where the actual price that the stock is buying or selling for is lower than the actual true value of the company. At that time, the company is undervalued and it's a really good time to buy. There's also going to be times where the price of the stock is valued way higher than what the true value of the stock should be based on their earnings and profitability. And at that time, that stock is overvalued, and that's not a good time to want to buy into the stock, even though that's what a lot of people do, because that's the time that they feel most confident either in the market or in that company. So that's kind of a brief explanation of how price works with stocks.